Today, in my private Discord, I went live with all of my members and I explained this concept to them, how to identify a gap fill, but most importantly, how to use it to make better trading decisions. We have just crossed an important threshold with my channel. I have been on the air for less than a year and we are already close to 15,000 subscribers. As a thank you to all of you, my loyal subscribers, I want to invite you in on this meeting that I had with all of my members so that you too can learn about this important concept. Good morning, everyone. I hope you all had a restful night so that we can get some good trades in today. I wanted to take you into a new concept that's different from what I've taught you before, and this will really help stretch your mind when you are trying to find the right entry point for a sold put. So we love to trade PLTR and we've made a lot of money off of it. I know that we are usually looking at our traditional charts that are the line chart you see right here. And one of the first things that we always look at when we are trying to find a point that we want to sell a put is the bottom of the Bollinger Band. Well, we're looking at a longer dated put, and you know I like those because we typically can go lower for a margin of safety and we can enjoy more premium than if we stuck with somewhere around the current price. So if we're going to do this, we definitely want to look out maybe a year to get the best sense for our price points, and it does look like $22 is at the bottom of that band. But what I want to show you is on a different chart, if you go right here and flip it from line to candle, kind of looks like Christmas right here. One of the first things that jumps out to me is a huge gap, and it took place right here. This was back in February, and a gap happens between your candles if the price action changes overnight from market close to market open. And when that happens, you usually leave a lot of traders behind. And so everyone was going along here with PLTR maybe at $17. Maybe they were hoping it would pull back to like the $16.50 area, and boom, it popped up to 21. So they woke up to this news and they were left behind. Well, that's fine and good for us that already have PLTR. But one other thing to look at and to notice is after we went on this run right here, we cannot seem to get above that 25, 26 level. We continue to just bounce up against it. It started right here and it poked its head above it just a little while, but it was quickly slapped back down and we are stuck right here. And the reason could be that our buyers are exhausted. We have pulled along anyone that's willing to buy this stock at the price that it jumped up to. So when that happens, we really need to have a stock retrace back down to where it left all of the other buyers that wanted to buy in and allow other people to jump on this particular investment. And when that happens, you can envision a little train coming here, and he comes back to the station, he loads up all his passengers, and then off we go again to new heights. The other thing that reinforces that price point is that 200-day moving average. So keeping these two things in mind, let's go shopping for a put that we want to sell that is closer to around the $17 mark. Going to our option chain, we are going to go all the way down to December 20th, and let's go take a look. So $17, it's paying $1.59 a share, which is really aggressive because if you were to be put the shares at this level, you'd actually be getting them for less than $16, which is a great deal for a PLTR. It is rated as a fair value at 16, so you would get it below a fair value, which is the whole point of selling puts to begin with. Also, you've got a decent amount of open interest here, so this might be a pretty good liquidity, long dated put for us to go and sell. But what we want to do is go ahead and let's put this on an option calculator so that we can see when we might be able to actually take profit at, let's say, the 50% level. All right, going into our calculator, we have everything teed up here for December 20th, the $17 cash secured put, and we want to look at 50%. So we would hit 50% if we jump up here to $28 by May the 2nd, which that would be a pretty quick turnaround for us. That would be great if that were to happen. And so if we look at that, let's go ahead and look at our profit and loss. We would be holding on to about $77. All we have to do is get to the $28 mark by May the 2nd, and we would put all that money in our pocket. For comparison purposes, let's go ahead and look at if we sold a shorter dated put that expired around May the 2nd, what we would pocket if we went a little bit higher than 17. Let's look at May the 17th. That would allow us to capture that May the 2nd date. So to achieve the $77 that we want, we would have to go really probably up to $20, because this would leave maybe another couple of weeks left in the option. So if we were to try to get the same amount of money as we're getting with our longer dated put 9 months from now, we would need to go to the $20 level, looking at the May expiration date. And this is why I encourage you to consider going much further out. It allows you to go much lower in your strike price, and if you see Palantir pulling back, you're not near as nervous as if you would have had this $20 strike price that was going to expire in May. So with this in mind, we can either go and sell these puts today, or we might want to wait and see till after the FOMC meeting and the Fed speaks to see what the market's going to do and determine if we're ready to do this, or if we just want to wait a little bit longer and let's let it pull back just a little bit more, and then we can get even more than what we already looked at. I hope you enjoyed the lesson, and I hope you can use it to make better trading decisions. If you too would like to be a part of my private group, please click the link below and speak with someone on my team, and they will give you all of the details, and you could be trading with us as early as next week.